Question 1. Investigation of how an underwriter should approach the assessment of technology risks for a financial services firm that has recently implemented a new AI-driven trading platform, considering the potential for novel cyber threats and operational disruptions to ensure accurate policy terms and pricing. Option A. Proactively engage with the client to understand the specific architecture, security protocols, and data governance surrounding the AI trading platform and assess potential failure modes and their impact. Option B. Assume the client's existing IT department has adequately addressed all technology risks associated with the new platform without further inquiry. Option C. Rely on general industry cyber insurance market data for financial services firms and apply a standard risk loading for technology-related exposures. Option D. Exclude all coverage related to the AI trading platform due to the perceived novelty and unquantifiable nature of the associated risks. Correct answer is A. Proactively engage with the client to understand the specific architecture, security protocols, and data governance surrounding the AI trading platform, and assess potential failure modes and their impact. Explanation. This scenario presents a professional challenge for an underwriter due to the evolving nature of technology risks and the need to balance comprehensive risk assessment with the practicalities of underwriting. The underwriter must consider how new technologies impact the insurability of a business, the potential for novel claims, and the adequacy of existing policy wordings. Careful judgment is required to avoid both underinsuring a client by failing to account for emerging risks and overinsuring by applying premiums that are disproportionate to the actual, quantifiable risk. The correct approach involves a proactive and informed engagement with the client's technology landscape. This means actively seeking detailed information about the specific technologies employed, the firm's cybersecurity measures, data governance policies, and incident response plans. This detailed understanding allows for a more accurate assessment of the likelihood and potential impact of technology-related claims, such as data breaches, system failures, or intellectual property theft arising from technological advancements. This aligns with the CII's emphasis on professional competence and due diligence, requiring underwriters to possess and apply up-to-date knowledge of relevant risks and market developments. It also reflects the ethical duty to act in the best interests of both the client and the insurer by ensuring fair and accurate pricing based on a thorough understanding of the risk. An incorrect approach would be to rely solely on generic industry data or past claims experience without delving into the specifics of the client's unique technological environment. This failure to gather specific information constitutes a breach of due diligence. It risks mispricing the policy, potentially leading to inadequate reserves for the insurer or an unfairly high premium for the client. Ethically, it fails to uphold the principle of transparency and fairness. Another incorrect approach would be to dismiss emerging technology risks as too speculative or unquantifiable, and therefore not a material consideration for underwriting. This demonstrates a lack of professional foresight and an unwillingness to adapt underwriting practices to the changing risk landscape. Such an approach could lead to significant underinsurance for the client, leaving them exposed to substantial financial losses that their insurance policy does not cover. This contravenes the underwriter's responsibility to provide appropriate cover. A further incorrect approach would be to apply a blanket exclusion for all technology-related risks without a nuanced assessment. While some exclusions may be necessary, a wholesale exclusion without considering the specific nature of the client's business and the potential impact of technology risks is overly broad and fails to meet the client's needs. This demonstrates a lack of understanding of how technology is integrated into modern business operations and a failure to provide appropriate insurance solutions. The professional decision-making process for similar situations should involve a structured approach. First, identify the core risk being underwritten. Second, research and understand the specific technological exposures relevant to that risk and the client's industry. Third, gather detailed information from the client regarding their technology infrastructure, security protocols, and data management practices. Fourth, assess the potential impact and likelihood of technology-related claims based on the gathered information. Fifth, determine appropriate policy terms, conditions, and pricing, including any necessary endorsements or exclusions. And finally, clearly communicate the rationale for underwriting decisions and policy terms to the client. Question 2. Market research demonstrates that clients often express a desire for immediate confirmation of their insurance cover following a successful underwriting assessment. An underwriter has completed the assessment for a commercial property insurance policy, identifying specific risks that necessitate endorsements to the standard policy wording and a higher premium than initially quoted. The client has verbally agreed to these revised terms. The underwriter is considering how to proceed with policy issuance. Which of the following approaches best adheres to regulatory requirements and professional best practice for policy documentation and issuance? Option A. Delay issuing any policy document until the client provides further, non-essential supporting documentation that was not a prerequisite for underwriting approval. Option B. Issue the standard policy document immediately, assuming the client will understand that the verbal agreement for endorsements will be communicated separately. Option C. Issue a policy document that precisely reflects the agreed endorsements and revised premium, even if this requires a short delay to ensure all details are accurately incorporated. Option D. Issue a policy document that uses highly technical insurance terminology to ensure legal precision, regardless of the client's potential understanding. Correct answer is C. Issue a policy document that precisely reflects the agreed endorsements and revised premium, even if this requires a short delay to ensure all details are accurately incorporated. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for accurate and complete policy documentation with the client's desire for expediency, while strictly adhering to regulatory requirements. The underwriter must ensure that all terms, conditions, and exclusions are clearly communicated and legally sound, preventing future disputes and ensuring compliance with the Financial Conduct Authority (FCA) principles. The correct approach involves issuing a policy document that is comprehensive, clear, and accurately reflects the agreed terms, including any endorsements or specific conditions identified during underwriting. This aligns with FCA Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate that firms must pay due regard to the interests of their customers and communicate information to them in a way that is clear, fair, and not misleading. The Insurance Conduct of Business Sourcebook, ICOBS, further reinforces this by detailing requirements for policy documentation, including the need for clarity on cover, exclusion, and policyholder rights. Issuing a document that precisely matches the underwriting decision, even if it requires a slight delay, upholds these principles and protects both the client and the insurer. An incorrect approach would be to issue a standard policy document without incorporating the specific endorsements or exclusions agreed upon during underwriting. This fails to meet the requirement of communicating accurate and specific terms to the client, potentially leading to a misunderstanding of their cover and violating FCA principles regarding fair treatment and clear communication. Another incorrect approach would be to issue a policy document that is overly complex or uses jargon that the client may not understand, even if it technically reflects the underwriting decision. This contravenes the spirit of ICOBS, which emphasizes clarity and accessibility of information for consumers. Finally, an incorrect approach would be to delay issuing the policy document indefinitely while awaiting further, non-essential information, thereby failing to provide the client with timely confirmation of their cover and potentially breaching regulatory expectations for prompt issuance of documentation. Professionals should adopt a decision-making process that prioritizes regulatory compliance and client interests. This involves thoroughly reviewing underwriting decisions, ensuring all agreed terms are accurately documented, and communicating these clearly and concisely to the client. If there is any ambiguity or potential for misunderstanding, the underwriter should seek clarification and ensure the final document is unambiguous. The process should also include a mechanism for timely issuance of documentation once all necessary information is confirmed and accurately reflected. Question 3. Benchmark analysis indicates that while the historical frequency of a specific type of natural disaster impacting the proposed portfolio is extremely low, the potential financial impact of such an event, if it were to occur, could be substantial and disproportionately affect the insurer's capital reserves. Which approach best addresses this situation from an advanced underwriting perspective, adhering to regulatory expectations for robust risk assessment? Option A. Prioritize underwriting other risks with higher historical frequencies, considering this low-frequency event as a minor concern that can be addressed through general contingency planning rather than specific impact analysis. Option B. Develop a series of severe but plausible scenario analyses, quantifying the potential financial impact of such an event on the insurer's capital under various defined conditions, and assess the adequacy of existing capital and reinsurance arrangements. Option C. Focus solely on the low historical frequency of the event, concluding that its probability is too remote to warrant significant capital allocation or specific risk mitigation strategies. Option D. Rely on standard industry-wide actuarial models for natural disaster risk, assuming they adequately capture the specific nuances and potential aggregation of losses for this particular portfolio. The correct answer is C. Focus solely on the low historical frequency of the event, concluding that its probability is too remote to warrant significant capital allocation or specific risk mitigation strategies. Explanation. This scenario presents a professional challenge because it requires the underwriter to move beyond simple statistical probabilities to assess the potential impact of a rare but significant event on a complex insurance portfolio. The challenge lies in accurately quantifying the potential financial consequences of such an event, which can be highly uncertain and difficult to model, while adhering to regulatory expectations for robust risk assessment and solvency. Careful judgment is required to balance the need for a comprehensive analysis with the practical limitations of data and modeling capabilities. The correct approach involves developing a scenario-based analysis that considers a range of plausible, severe but credible events and their potential impact on the insurer's capital. This aligns with regulatory expectations for insurers to understand and manage their exposure to extreme events. By focusing on the potential financial consequences of specific, defined scenarios, the underwriter can provide a more nuanced and actionable assessment of risk than relying solely on historical frequency data. This approach supports the insurer's ability to maintain solvency and meet its obligations to policyholders, a core principle of insurance regulation. An incorrect approach would be to dismiss the event due to its low historical frequency, ignoring the potential for catastrophic impact. This fails to meet the regulatory duty to assess all material risks, including those that are infrequent but severe. Another incorrect approach is to rely solely on standard actuarial models without considering the specific characteristics of the proposed portfolio and the potential for aggregation of losses under extreme conditions. This overlooks the need for tailored risk assessment and can lead to an underestimation of potential capital requirements. Finally, an approach that focuses only on the direct financial cost of claims, without considering indirect impacts such as business interruption, reputational damage, or increased reinsurance costs, would be incomplete and fail to provide a holistic view of the potential impact. Professionals should adopt a decision-making framework that begins with identifying potential extreme events relevant to the portfolio. This should be followed by a qualitative assessment of the potential impact, and then a quantitative analysis using scenario modeling. The results should be reviewed by senior management and integrated into the insurer's overall risk management framework and capital planning. This iterative process ensures that the assessment is thorough, considers a range of possibilities, and is aligned with regulatory requirements for prudent risk management. Question 4. The review process indicates that a prospective corporate client has a complex ownership structure involving several layers of holding companies registered in different jurisdictions. The client has provided a list of the current directors of the immediate parent company. Which of the following represents the most appropriate approach to fulfilling anti-money laundering (AML) obligations regarding the identification of ultimate beneficial owners (UBO? Option A. Defer the detailed identification of UBOs until after the client has been onboarded and the business relationship is established. Option B. Conduct further due diligence to identify individuals who ultimately own or control the corporate client, even if this requires requesting additional documentation beyond the immediate parent company's directorships. Option C. Proceed with onboarding the client based on the assumption that the provided documentation is complete and the ownership structure is straightforward. Option D. Accept the provided list of directors as sufficient identification of UBOs, as they are legally responsible for the company's management. The correct answer is D. Accept the provided list of directors as sufficient identification of UBOs, as they are legally responsible for the company's management. Explanation. This scenario presents a professional challenge due to the inherent tension between efficient client onboarding and the stringent requirements of anti-money laundering AML regulations. Underwriters must exercise careful judgment to balance the need for timely business acquisition with the imperative to prevent financial crime. The complexity arises from identifying and verifying the ultimate beneficial ownership, UBO, of a corporate client, especially when the ownership structure is opaque or involves multiple layers of intermediaries. Failure to adequately identify UBOs can expose the firm to significant regulatory penalties, reputational damage, and complicity in illicit activities. The correct approach involves a thorough and documented investigation into the client's ownership structure, seeking to identify all individuals who ultimately own or control the corporate entity. This includes scrutinizing shareholding patterns, directorships, and any other arrangements that might indicate control, even if not explicitly stated in formal documentation. The regulatory justification stems from the Money Laundering Regulations 2017, as amended, which mandate that regulated entities must identify and verify the identity of their customers, and crucially, the UBOs of legal persons and arrangements. This proactive and diligent approach ensures compliance with the Know Your Customer (KIC) principle and the broader objective of preventing money laundering and terrorist financing. An incorrect approach would be to accept the provided list of directors as definitive proof of UBO without further investigation. This fails to acknowledge that directors may not always be the ultimate controllers of a company. Significant shareholders or individuals with significant influence through other means could be the true UBOs. This approach risks non-compliance with the Money Laundering Regulations 2017, specifically the requirement to identify individuals who ultimately own or control the client. Another incorrect approach would be to proceed with onboarding based on the assumption that the corporate structure is straightforward and that the provided documentation is exhaustive. This demonstrates a lack of due diligence and a failure to apply a risk-based approach, which is a cornerstone of AML compliance. The regulatory failure here is the omission of necessary steps to ascertain UBO, potentially leading to the firm being used for illicit purposes, thereby breaching the spirit and letter of the AML legislation. A further incorrect approach would be to defer the UBO identification to a later stage, perhaps after the initial onboarding is complete. This is a critical regulatory and ethical failure. AML obligations, including UBO identification, are a prerequisite for establishing a business relationship, not an optional add-on. Delaying this process significantly increases the risk of onboarding a high-risk client without adequate controls in place, contravening the proactive and preventative nature of AML regulations. The professional decision-making process for similar situations should involve a risk-based assessment from the outset. Underwriters must be trained to identify red flags associated with complex ownership structures. When such red flags are present, the default position should be to conduct enhanced due diligence, which includes a detailed examination of ownership and control. This involves requesting and scrutinizing relevant documentation, potentially seeking external verification, and documenting all steps taken and decisions made. If UBO cannot be definitively identified to a satisfactory standard, the firm should consider declining to onboard the client or terminating the relationship, as per regulatory guidance. Question 5. The performance metrics show that the underwriting team is consistently falling short of its target for the number of applications processed per day, and there is pressure from senior management to increase throughput. You are reviewing a complex application that requires careful consideration of several medical disclosures and financial stability factors, and it is taking significantly longer than the average to underwrite. You are aware that a more superficial review, or simply accepting the applicant's stated information at face value for less complex cases, would allow you to process more applications and meet the daily target. What is the most appropriate course of action to uphold professional standards and regulatory requirements? Option A. Conduct a thorough and detailed review of the complex application, documenting all findings and rationale, even if it means not meeting the daily processing target for this specific application. Option B. Defer the detailed review of the complex application to a later date, focusing on processing simpler applications to meet the daily target in the interim. Option C. Expedite the review of the complex application by focusing only on the most critical disclosures and assuming the accuracy of other information to meet the daily processing target. Option D. Process the complex application quickly by applying a less stringent set of underwriting criteria than usual to align with the team's overall performance metrics. The correct answer is A. Conduct a thorough and detailed review of the complex application, documenting all findings and rationale, even if it means not meeting the daily processing target for this specific application. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficiency and meeting performance targets with the fundamental ethical and regulatory obligation to maintain the integrity and accuracy of underwriting decisions. The underwriter is under pressure to process a high volume of applications, which can lead to a temptation to cut corners or overlook critical details. The core of the challenge lies in upholding the principles of sound underwriting and regulatory compliance when faced with internal performance pressures. The correct approach involves a commitment to thoroughness and adherence to established quality assurance procedures, even when time is constrained. This means meticulously reviewing each case against underwriting guidelines and regulatory requirements, seeking clarification when necessary, and documenting all decisions and rationale. This approach is ethically sound and regulatorily compliant because it prioritizes accuracy, fairness, and the protection of both the insurer and the policyholder. It directly addresses the CII's emphasis on professional conduct and the importance of robust risk assessment in underwriting. Adhering to these procedures ensures that underwriting decisions are not compromised by speed, thereby preventing potential adverse selection, misrepresentation, and regulatory breaches. An incorrect approach that prioritizes speed over accuracy would involve overlooking minor discrepancies or assuming information is correct without verification to meet processing targets. This is ethically problematic as it can lead to the acceptance of substandard risks, potentially resulting in future claims that the insurer is not adequately prepared for, and it breaches the regulatory duty to underwrite prudently. Another incorrect approach, which involves selectively applying quality assurance checks based on perceived risk or volume, is also unacceptable. This selective application undermines the systematic nature of quality assurance, creating inconsistencies and increasing the likelihood of errors being missed. It fails to meet the regulatory expectation of a consistent and robust control environment. A third incorrect approach, which involves deferring complex cases or those with potential issues to a later stage without proper interim review, can lead to backlogs and a loss of oversight. This can result in decisions being made under undue pressure or with incomplete information, again compromising the integrity of the underwriting process and potentially leading to regulatory noncompliance. Professionals should adopt a decision-making framework that prioritizes ethical conduct and regulatory compliance above all else. This involves understanding the underlying principles of underwriting and quality assurance, recognizing the potential consequences of deviations, and having the courage to challenge internal pressures that conflict with these principles. When faced with conflicting demands, professionals should seek guidance from senior management or compliance departments and always document their actions and rationale. The focus should always be on making sound, defensible decisions that uphold the reputation and integrity of the profession and the organization. Question 6. Assessment of the process optimization for a life insurance company's underwriting department, focusing on how to enhance data acquisition efficiency while ensuring absolute compliance with the General Data Protection Regulation, GDPR. Which of the following approaches best balances these objectives? Option A. Automating the sharing of applicant data with marketing partners to identify potential cross-selling opportunities without explicit consent for this secondary purpose. Option B. Expanding data collection to include all available third-party data sources, regardless of direct relevance to underwriting, to build the most complete risk profile possible. Option C. Relying on legacy data processing systems that have not been updated for GDPR compliance, assuming that historical data is exempt from current regulations. Option D. Implementing a comprehensive data governance framework that mandates data minimization, purpose limitation, and robust security measures throughout the underwriting workflow, with regular audits to ensure adherence. The correct answer is D. Implementing a comprehensive data governance framework that mandates data minimization, purpose limitation, and robust security measures throughout the underwriting workflow, with regular audits to ensure adherence. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient data processing to underwrite effectively with the stringent legal obligations surrounding personal data protection. Underwriters must make informed decisions based on accurate and comprehensive information, but this must be achieved without infringing on an individual's right to privacy. The challenge lies in identifying and implementing data processing methods that are both compliant with data protection legislation and conducive to sound underwriting practices. Careful judgment is required to ensure that data collection, storage, and usage are proportionate, lawful, and transparent. The correct approach involves implementing a robust data privacy compliance framework that integrates data minimization, purpose limitation, and secure data handling practices directly into the underwriting process. This means only collecting data that is strictly necessary for the underwriting decision, clearly defining and adhering to the specific purposes for which that data is used, and employing strong security measures to protect it. This approach is justified by the General Data Protection Regulation, GDPR, which mandates these principles. Specifically, Article 5 of the GDPR outlines the principles relating to processing of personal data, including lawfulness, fairness, transparency, purpose limitation, data minimization, accuracy, storage limitation, integrity, and confidentiality. By adhering to these, the insurer demonstrates a commitment to lawful and ethical data handling, thereby mitigating legal risks and building trust with policyholders. An incorrect approach that focuses solely on acquiring the maximum amount of data available, without a clear justification for each data point's necessity for underwriting, fails to uphold the principle of data minimization. This could lead to the collection of excessive personal data, increasing the risk of a data breach and violating Article 5(1)(c) of the GDPR. Another incorrect approach that involves sharing personal data with third parties without explicit consent or a legitimate legal basis, and without ensuring those third parties also adhere to data protection standards, directly contravenes Article 6 and Article 44 onwards of the GDPR concerning lawful processing and international data transfers. This exposes the insurer to significant fines and reputational damage. A third incorrect approach that neglects to implement adequate technical and organizational measures to secure personal data, such as encryption or access controls, violates the principle of integrity and confidentiality under Article 5(1)(f) of the GDPR and Article 32 concerning security of processing. Professionals should adopt a proactive and risk-based approach to data privacy. This involves conducting regular data protection impact assessments, DPIA, for new underwriting processes or significant changes, ensuring all staff involved in underwriting receive comprehensive data protection training, and establishing clear internal policies and procedures for data handling. When faced with a decision regarding data usage, the professional should ask, is this data absolutely necessary for the underwriting decision? What is the specific purpose for collecting and using this data? How will this data be protected? Are we transparent with the data subject about how their data is being used? If the answer to any of these questions raises concerns about compliance with data protection principles, the approach should be revised. Question 7. Upon reviewing the income statement of a prospective corporate client, an underwriter observes a significant increase in reported net profit over the past 2 financial years. However, a closer examination reveals that a substantial portion of this increase is attributable to a change in accounting policy regarding the capitalization of certain development costs, alongside a one-off gain from the sale of an underutilized subsidiary. Which approach to analyzing this income statement provides the most robust and compliant assessment of the applicant's underlying profitability and risk? Option A. Focusing on the trend of increasing gross profit margin and the overall growth in revenue, assuming these are indicative of strong operational performance. Option B. Giving significant weight to the positive impact of the sale of the subsidiary on the net profit, as it demonstrates the company's ability to generate capital. Option C. Dissecting the income statement to understand the drivers of the net profit increase, distinguishing between recurring operational profits and non-recurring items, and assessing the sustainability of the core business's profitability. Option D. Prioritizing the analysis of the reported net profit figure, considering the recent upward trend as evidence of improved financial health. The correct answer is A. Focusing on the trend of increasing gross profit margin and the overall growth in revenue, assuming these are indicative of strong operational performance. Explanation. This scenario presents a professional challenge because the underwriter must interpret complex financial data to assess risk accurately, while adhering strictly to the regulatory framework governing the advanced underwriting exam. CII. The challenge lies in distinguishing between genuine operational improvements and potentially misleading accounting practices that could inflate profitability, thereby misrepresenting the true risk profile of the applicant. Careful judgment is required to ensure that underwriting decisions are based on a robust and compliant understanding of the applicant's financial health. The correct approach involves a detailed examination of the income statement, focusing on the quality of earnings and the sustainability of revenue streams. This includes scrutinizing the gross profit margin trends, the nature of operating expenses, identifying any one-off or exceptional items, and the impact of non-operating income or expenses on the overall profit. This approach is correct because it aligns with the CII's regulatory framework, which mandates a thorough and objective assessment of an applicant's financial position. By focusing on the underlying operational performance and the consistency of profit generation, the underwriter upholds the ethical duty to provide accurate risk assessments and avoid adverse selection. This method ensures that underwriting decisions are informed by the applicant's true financial capacity and not by potentially transient or manipulated figures. An incorrect approach would be to solely focus on the reported net profit figure without dissecting its components. This is professionally unacceptable because it ignores the regulatory requirement for a deep dive into the financial statements. It fails to identify potential red flags such as aggressive revenue recognition policies or the capitalization of expenses, which can artificially boost profits. This superficial analysis could lead to an underestimation of risk, potentially resulting in the acceptance of business that is not financially sound, thereby breaching underwriting principles and regulatory expectations. Another incorrect approach would be to place undue emphasis on short-term revenue growth without considering the profitability or cost structure associated with that growth. This is flawed because rapid revenue increases might be achieved through unsustainable pricing strategies or high marketing expenditure that erodes profit margins. The regulatory framework expects underwriters to assess the long-term viability of an applicant's business model, not just its immediate top-line performance. Ignoring the cost implications of revenue generation leads to an incomplete risk assessment. A third incorrect approach would be to overlook the impact of significant non-recurring items on the income statement, such as the sale of assets or substantial legal settlements. While these items can impact the net profit, they do not reflect the ongoing operational performance of the business. The regulatory framework requires underwriters to distinguish between recurring and non-recurring factors to understand the true underlying profitability and risk. Failing to do so can lead to misjudgments about the applicant's future earning capacity. A professional decision-making process for similar situations should involve a systematic review of the income statement, starting with an understanding of the applicant's industry and business model. This should be followed by a detailed analysis of each line item, paying close attention to trends, consistency, and the nature of income and expenses. The underwriter must then critically evaluate the quality and sustainability of the reported profits, considering any potential accounting manipulations or unusual events. This analytical rigor, guided by regulatory requirements and ethical principles, ensures that underwriting decisions are sound, compliant, and protect both the insurer and the applicant. Question 8. Quality control measures reveal that a significant portion of underwriting decisions for a new life insurance product are being influenced by data obtained from a third-party credit scoring agency. The underwriter is concerned about the potential for this data to be outdated, biased, or obtained without full applicant awareness. Which of the following represents the most appropriate course of action for the underwriting department to ensure compliance with regulatory frameworks and ethical best practices? Option A. Conduct a comprehensive review of the third-party credit scoring agency, including their data sources, validation methodologies, data retention policies, and compliance with data protection regulations, and establish clear guidelines for the acceptable use of this data in underwriting. Option B. Immediately cease all use of the third-party credit scoring data and revert to manual underwriting processes based solely on applicant-provided information. Option C. Continue using the third-party credit scoring data as it is provided by a reputable agency, assuming the agency adheres to its own internal compliance standards. Option D. Implement a policy that requires applicants to explicitly consent to the use of their credit score for underwriting purposes, but without independently verifying the accuracy or potential biases of the credit scoring data itself. The correct answer is B. Immediately cease all use of the third-party credit scoring data and revert to manual underwriting processes based solely on applicant-provided information. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the ethical and regulatory obligations concerning the use of third-party data. The underwriter must ensure that any data used is reliable, relevant, and obtained and processed in a manner that respects data privacy and avoids unfair discrimination. The core challenge lies in verifying the integrity and appropriateness of data sources that are external to the direct applicant interaction. The correct approach involves a multifaceted verification process. This includes not only assessing the data provider's reputation and data validation methods, but also understanding how the data was collected and whether it complies with relevant data protection regulations, such as the UK's General Data Protection Regulation, GDPR, and the Financial Conduct Authority's, FCA, principles. Critically, the underwriter must ensure that the data is used in a way that is transparent to the applicant and does not lead to discriminatory outcomes, aligning with the FCA's principles of treating customers fairly. This approach prioritizes regulatory compliance, ethical data handling, and robust risk assessment. An incorrect approach would be to solely rely on the third-party data provider's assurances without independent verification. This fails to meet the underwriter's duty of care and regulatory obligations to ensure the accuracy and appropriateness of information used in underwriting decisions. It also risks using data that may be outdated, biased, or obtained through non-compliant means, leading to unfair outcomes for applicants and potential breaches of data protection laws. Another incorrect approach is to use third-party data without informing the applicant or obtaining appropriate consent where required. This violates principles of transparency and data privacy, potentially breaching GDPR requirements and the FCA's principles of treating customers fairly. Applicants have a right to know what information is being used to assess their risk and how it was obtained. A further incorrect approach is to use third-party data that may inadvertently lead to discriminatory practices, even if the data itself is not explicitly discriminatory. For example, using data that correlates with protected characteristics without a clear, justifiable underwriting purpose could lead to unfair treatment and breaches of equality legislation. The underwriter must actively consider the potential for indirect discrimination. Professionals should adopt a decision-making framework that begins with identifying the purpose for using third-party data. This should be followed by a thorough due diligence process on the data provider, including their data collection, validation, and security practices. The underwriter must then assess the relevance and reliability of the specific data points for the underwriting decision, ensuring compliance with all applicable regulations, including data protection and anti-discrimination laws. Transparency with the applicant and a clear understanding of how the data influences the underwriting decision are paramount. Question 9. Performance analysis shows that the company's current profitability targets are being met, but the enterprise risk management framework is significantly underfunded, leading to a potential gap in identifying and mitigating emerging risks. The underwriting director is aware that a substantial increase in investment is required to meet regulatory expectations and ensure long-term solvency, but this would likely impact short-term profit margins. What is the most appropriate course of action for the underwriting director? Option A. Advocate for the necessary investment, presenting a clear business case that outlines the long-term benefits and regulatory compliance requirements, even if it means adjusting short-term profit expectations. Option B. Proceed with a superficial implementation that appears to meet regulatory requirements, but does not involve substantial investment or deep risk analysis. Option C. Defer the significant investment until the next financial year, focusing on meeting current profitability targets and addressing the gap with minimal expenditure. Option D. Focus solely on the cost savings of delaying investment, highlighting the immediate positive impact on profitability to senior management. The correct answer is A. Advocate for the necessary investment, presenting a clear business case that outlines the long-term benefits and regulatory compliance requirements, even if it means adjusting short-term profit expectations. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial pressures of the company with the long-term strategic imperative of robust enterprise risk management. The underwriting director is faced with a situation where a perceived short-term gain, avoiding immediate investment, could lead to significant long-term detriment, potentially impacting solvency, regulatory compliance, and ultimately, customer trust. The ethical dilemma lies in prioritizing stakeholder interests, particularly policyholders, over short-term financial expediency. Careful judgment is required to ensure that risk appetite is aligned with the company's capacity to absorb losses and that regulatory obligations are met. The correct approach involves advocating for the necessary investment, even if it impacts short-term profitability. This aligns with the fundamental principles of sound financial management and regulatory compliance expected of insurance entities. Specifically, it upholds the duty to maintain adequate financial resources to meet policyholder obligations, a core tenet of insurance regulation. By prioritizing the director demonstrates a commitment to proactive risk identification, assessment, and mitigation, which is essential for long-term business sustainability and regulatory adherence. This approach is ethically sound as it prioritizes the security of policyholders and the stability of the company, reflecting a responsible stewardship of entrusted funds. An incorrect approach would be to defer or significantly reduce the investment to meet immediate profit targets. This fails to acknowledge the potential for unmitigated risks to materialize, leading to substantial financial losses that could jeopardize the company's solvency. Such a decision would likely contravene regulatory requirements for prudent risk management and capital adequacy, potentially exposing the company to supervisory intervention. Ethically, it represents a failure to act in the best interests of policyholders, who rely on the insurer's financial strength. Another incorrect approach would be to proceed with the implementation without adequate consultation or understanding of the underlying risks. This could lead to misallocation of resources or the adoption of ineffective risk management strategies, failing to achieve the intended benefits of and potentially creating new, unforeseen risks. This approach lacks the diligence and strategic foresight required for effective and could be seen as a superficial attempt to meet regulatory expectations without genuine commitment. A further incorrect approach would be to solely focus on the cost of without a comprehensive assessment of the potential benefits and the cost of inaction. This narrow financial perspective ignores the strategic value of in enhancing decision-making, improving operational efficiency, and protecting the company's reputation. It also overlooks the potential for significant financial and reputational damage if risks are not adequately managed. The professional decision-making process for similar situations should involve a thorough risk assessment of the proposed investment, including a cost-benefit analysis that quantifies both the potential financial gains and losses associated with different levels of maturity. This should be coupled with a clear understanding of the company's risk appetite and tolerance, as defined by senior management and the board. The director should then present a well-reasoned case to senior management and the board, highlighting the regulatory imperatives, ethical considerations, and long-term strategic benefits of adequate investment, advocating for a solution that balances short-term financial performance with long-term risk resilience and solvency. Question 10. Implementation of an economic capital model within the Advanced Underwriting Exam, CII. Jurisdiction presents an underwriter with several strategic choices. Which approach best aligns with regulatory expectations for risk assessment and capital management? Option A. Employing the economic capital model to inform strategic decisions regarding risk appetite, capital allocation, and business planning, ensuring the model's outputs are validated and understood in the context of regulatory solvency and reporting obligations. Option B. Adopting the most complex and theoretically advanced economic capital model available, irrespective of its practical applicability or the firm's capacity to understand and manage its outputs, to demonstrate a commitment to sophisticated risk management. Option C. Utilizing the economic capital model's output primarily to identify areas where capital can be reduced to improve profitability, without a comprehensive review of the model's underlying assumptions or its alignment with regulatory capital requirements. Option D. Focusing solely on the historical performance data used in the economic capital model to justify current capital levels, neglecting the forward-looking nature of risk assessment and the potential for future adverse events. The correct answer is C. Utilizing the economic capital model's output primarily to identify areas where capital can be reduced to improve profitability, without a comprehensive review of the model's underlying assumptions or its alignment with regulatory capital requirements. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the theoretical underpinnings of economic capital modeling with the practical realities of regulatory compliance and business strategy. The underwriter must not only understand how economic capital models are constructed, but also how their outputs are interpreted and applied within the specific regulatory framework of the Advanced Underwriting Exam (CII) jurisdiction. The core challenge lies in selecting an approach that accurately reflects the firm's risk profile, while remaining compliant with regulatory expectations for capital adequacy and solvency. Careful judgment is required to avoid over-reliance on simplistic interpretations or the adoption of methodologies that, while potentially sophisticated, do not align with the regulatory intent. The correct approach involves using economic capital modeling outputs to inform strategic decisions about risk appetite and capital allocation, ensuring that the model's results are validated and understood in the context of regulatory requirements. This approach is right because it directly addresses the purpose of economic capital modeling within a regulated environment, to provide a robust measure of risk that can be used for both internal management and external reporting. Regulatory frameworks, such as those governing the CII Advanced Underwriting Exam, emphasize the importance of sound risk management and adequate capital resources. By using economic capital to inform strategic decisions and capital allocation, the underwriter demonstrates a commitment to these principles, ensuring that the firm's capital is deployed efficiently and effectively to cover its risks, thereby maintaining solvency and meeting regulatory obligations. This aligns with the principle of prudent financial management and the overarching goal of protecting policyholders. An incorrect approach would be to solely focus on minimizing the calculated economic capital figure for the purpose of reducing regulatory capital requirements, without a thorough understanding of the underlying risks or the model's limitations. This is professionally unacceptable because it prioritizes a superficial compliance outcome over genuine risk management. Regulators expect firms to understand and manage their risks, not merely to manipulate capital figures. Such an approach could lead to an underestimation of true risk, potentially resulting in insufficient capital to absorb unexpected losses, thereby jeopardizing the firm's solvency and failing to protect policyholders. This constitutes a regulatory failure by not adhering to the spirit of capital adequacy rules, and an ethical failure by potentially misleading stakeholders about the firm's risk position. Another incorrect approach would be to adopt a complex economic capital model without adequate validation or understanding of its assumptions and limitations, simply because it is perceived as more sophisticated. This is professionally unacceptable, as it introduces a significant risk of misinterpreting the firm's risk profile. If the model is not fit for purpose or its outputs are not properly understood, the resulting capital allocation and strategic decisions could be flawed, leading to an inadequate buffer against potential losses. This represents a regulatory failure by not ensuring that risk management systems are robust and effective, and an ethical failure by potentially exposing the firm and its policyholders to undue risk due to a lack of due diligence. The professional decision-making process for similar situations should involve a systematic evaluation of the economic capital model's purpose, its methodology, its outputs, and its implications for both business strategy and regulatory compliance. Professionals must first clearly define the objective of using economic capital modeling. Then, they should critically assess the chosen model's suitability, ensuring it is validated and its assumptions are reasonable and documented. The outputs should be interpreted in the context of the firm's risk appetite and strategic goals, always with an eye towards regulatory requirements. Finally, decisions based on economic capital should be transparent, well documented, and subject to ongoing review and refinement. Question 11. Which approach would be most appropriate for an underwriter in the UK to select a data visualization tool for analyzing complex underwriting data, considering both analytical effectiveness and regulatory compliance? Option A. opting for the most widely used and cost-effective tool available on the market, as its popularity suggests it meets industry standards. Option B, focusing on tools that can generate visually striking dashboards quickly, with the intention of manually reviewing data sensitivity before sharing any outputs. Option C, prioritizing tools with advanced interactive features and a wide range of chart types, assuming that the underlying data is already sufficiently protected. Option D, selecting a tool that offers comprehensive security features, granular data access controls, and demonstrable compliance with UK data protection regulations, even if it has a steeper learning curve. The correct answer is C, prioritizing tools with advanced interactive features and a wide range of chart types, assuming that the underlying data is already sufficiently protected. Explanation: this scenario presents a professional challenge because the underwriter must select a data visualization tool that not only effectively communicates complex underwriting data, but also adheres to the stringent data protection and privacy regulations governing the insurance industry in the UK, as stipulated by the CII Advanced Underwriting Exam Framework. The choice of tool has direct implications for compliance with the Financial Conduct Authority (FCA) handbook, particularly principles related to treating customers fairly and maintaining adequate systems and controls, as well as the General Data Protection Regulation (GDPR). If personal data is involved, the underwriter needs to balance the need for insightful analysis with the imperative to safeguard sensitive client information and ensure regulatory compliance. The correct approach involves selecting a data visualization tool that has robust security features, offers granular control over data access and sharing, and allows for anonymization or pseudonymization of data where appropriate, all while providing clear and accurate representations of underwriting trends and risks. This aligns with the FCA's principles for businesses, specifically Principle 3 Adequate Systems and Controls and Principle 6 Customers' Interests, which necessitate the protection of client data and the provision of clear, understandable information. Furthermore, it directly addresses the requirements of GDPR concerning data minimization, purpose limitation, and the security of personal data. The tool's ability to generate reports that are easily understood by stakeholders, without compromising data integrity or confidentiality, is paramount. An approach that prioritizes only the aesthetic appeal and ease of use of a data visualization tool, without adequately assessing its security protocols and compliance with data protection laws, represents a significant regulatory and ethical failure. Such a tool might inadvertently expose sensitive underwriting data, leading to breaches of client confidentiality and potential regulatory sanctions under GDPR and the FCA handbook. Similarly, selecting a tool that offers extensive customization but lacks clear audit trails or robust access controls could facilitate unauthorized data access or manipulation, violating the principle of adequate systems and controls. An approach that relies solely on readily available free online tools without due diligence on their data handling practices is also problematic, as these often lack the necessary security assurances and compliance frameworks required for regulated financial services. Professional decision-making in such situations requires a systematic evaluation of data visualization tools against a checklist of criteria that includes data security features, compliance certifications, data anonymization capabilities, access control mechanisms, audit trail functionality, and the clarity and accuracy of the visualizations produced. The underwriter should consult internal IT security policies and relevant regulatory guidance to ensure the chosen tool meets all requirements before implementation. Question 12. The analysis reveals that an underwriter is reviewing a complex commercial property claim where the policy wording regarding business interruption coverage is ambiguous. The policyholder has submitted a claim for significant losses, supported by detailed financial projections. The underwriter suspects the projections may be overly optimistic, but lacks definitive evidence to refute them entirely. The underwriter is considering how to approach settlement negotiations to achieve a fair outcome for both the insurer and the policyholder, while adhering to regulatory requirements. Which of the following approaches best reflects the underwriter's professional and regulatory obligations in this scenario? Option A. Make a low initial offer based on the underwriter's personal assessment of the projection's unreliability, without clearly articulating the basis for this assessment to the policyholder. Option B. Immediately offer the full amount claimed by the policyholder to avoid a lengthy and potentially costly dispute, assuming the projections are accurate. Option C. Propose a settlement figure based on a conservative interpretation of the ambiguous policy wording, clearly explaining the rationale and inviting the policyholder to provide further evidence to support a higher figure. Option D. Delay the settlement negotiation process by requesting extensive and potentially irrelevant documentation, hoping the policyholder will withdraw or reduce their claim. The correct answer is C. Propose a settlement figure based on a conservative interpretation of the ambiguous policy wording, clearly explaining the rationale and inviting the policyholder to provide further evidence to support a higher figure. Explanation. This scenario presents a professionally challenging situation because it requires the underwriter to balance the insurer's financial interests with the policyholder's need for a fair settlement, all while adhering to strict regulatory requirements and ethical obligations. The underwriter must navigate the complexities of the policy terms, the evidence presented, and the potential for litigation, making a judgment call that could have significant financial and reputational consequences. Careful judgment is required to ensure that the settlement offer is both commercially viable for the insurer and equitable for the policyholder, avoiding any perception of unfair dealing. The correct approach involves a thorough and objective assessment of the claim's validity and the policy's coverage, followed by a settlement negotiation that is conducted in good faith and in accordance with the principles of fair treatment of customers. This means understanding the policy wording precisely, evaluating all submitted evidence impartially, and making an offer that reflects a reasonable interpretation of the policy terms in light of the facts. Negotiation should be transparent, with clear communication of the basis for the offer and a willingness to consider counterarguments or additional evidence. This aligns with the regulatory framework's emphasis on treating customers fairly and acting with integrity, particularly the principles outlined in the FCA's Conduct of Business (COBS) sourcebook, which mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their customers. An incorrect approach would be to make an offer that is significantly below the likely value of the claim, based on a narrow or overly aggressive interpretation of the policy wording, without adequate justification or consideration of the policyholder's circumstances. This could be seen as an attempt to exploit a perceived vulnerability of the policyholder and would likely breach the duty to treat customers fairly. Such an approach could lead to regulatory sanctions, reputational damage, and potential legal challenges from the policyholder. Another incorrect approach would be to concede to the policyholder's demands without proper investigation or consideration of the policy terms, simply to avoid a protracted negotiation or potential dispute. While efficiency is important, this approach fails to uphold the underwriter's responsibility to the insurer to manage risk and ensure that claims are settled appropriately according to the policy contract. This could result in financial losses for the insurer and set a precedent for future claims. A third incorrect approach would be to engage in misleading or evasive communication during the negotiation. This could involve withholding relevant information about the policy coverage or the basis for the settlement offer, or making promises that cannot be fulfilled. Such behavior undermines trust and is contrary to the ethical obligation to act with integrity and transparency. The professional decision-making process for similar situations should involve a systematic review of the claim against the policy terms, a comprehensive evaluation of all supporting evidence, and an objective assessment of the claim's value. Underwriters should be aware of their regulatory obligations regarding fair treatment of customers and act with integrity throughout the negotiation process. They should document their decision-making rationale clearly and be prepared to justify their settlement offers based on the policy and the facts. If there is uncertainty, seeking advice from senior colleagues or legal counsel is a prudent step. Question 13. The monitoring system demonstrates that the insurer's solvency ratio has decreased by 5% over the last 2 quarters, although it remains 10% above the minimum regulatory requirement. The underwriter notes this decrease, but considers it acceptable given the current market volatility, which approach best reflects professional underwriting practice in this situation. Option A. Focus solely on the insurer's ability to meet its immediate claims obligations, as the solvency ratio is a long-term measure. Option B. Accept the solvency ratio as satisfactory because it still exceeds the minimum regulatory threshold, and market volatility is a known factor. Option C. Investigate the underlying causes of the solvency ratio decrease and assess its potential impact on future solvency, even though it remains above the minimum requirement. Option D. Request an immediate increase in capital from shareholders to compensate for the observed decrease. The correct answer is C. Investigate the underlying causes of the solvency ratio decrease and assess its potential impact on future solvency, even though it remains above the minimum requirement. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the underwriter to interpret financial data beyond simple calculation, focusing on the underlying implications for risk and solvency. The challenge lies in discerning whether a particular ratio, while within acceptable numerical bounds, signals a deteriorating trend or a potential future issue that could impact the insurer's ability to meet its obligations. This demands a nuanced understanding of financial health and regulatory expectations, moving beyond a tick-box approach to ratio analysis. Careful judgment is required to balance immediate profitability with long-term solvency and policyholder protection, as mandated by regulatory frameworks. Correct approach analysis. The correct approach involves recognizing that a ratio, even if it appears acceptable in isolation, must be viewed within the context of trends and industry benchmarks. A slight deterioration in a key solvency ratio, even if still above the minimum regulatory requirement, warrants further investigation. This proactive stance aligns with the regulatory duty to ensure the insurer remains solvent and can meet its liabilities. The CII's advanced underwriting syllabus emphasizes a forward-looking perspective, where underwriters are expected to identify potential risks early. This approach demonstrates a commitment to prudent underwriting and adherence to principles of financial soundness, which are implicitly and explicitly supported by regulatory objectives aimed at protecting policyholders and maintaining market stability. Incorrect approach is analysis, focusing solely on the current ratio value and deeming it acceptable because it exceeds the minimum regulatory threshold, fails to acknowledge the importance of trend analysis. This approach is professionally unacceptable as it ignores potential early warning signs of financial stress. Regulators expect underwriters to be vigilant and to identify deteriorating financial positions before they become critical. This oversight could lead to a breach of solvency requirements in the future, directly contravening the regulatory objective of ensuring insurer solvency. Another incorrect approach is to dismiss the ratio's significance because it is not a direct breach of a specific solvency capital requirement, SCR, calculation. While SCR is paramount, the underlying financial health indicated by various ratios contributes to the overall ability to meet SCR. Ignoring a negative trend in a supporting ratio demonstrates a lack of comprehensive risk assessment and a failure to uphold the spirit of regulatory oversight, which aims to prevent problems before they manifest as breaches of core capital requirements. Finally, attributing the ratio's movement solely to external market factors without internal investigation is also professionally unsound. While external factors play a role, an underwriter's responsibility is to understand how these factors impact the insurer's specific financial position and to assess the adequacy of the insurer's risk management strategies. A failure to investigate the internal implications of external trends represents a dereliction of duty in risk assessment and management. Professional reasoning. Professionals should adopt a dynamic and holistic approach to ratio analysis. This involves 1. Establishing a baseline for key financial ratios. 2. Continuously monitoring these ratios against historical trends and industry benchmarks. 3. Investigating any significant deviations or deteriorating trends, regardless of whether they immediately breach regulatory minimums. 4. Considering the qualitative factors that may influence ratio performance. 5. Documenting the analysis and any actions taken to mitigate identified risks. This systematic process ensures that potential financial weaknesses are identified and addressed proactively, aligning with regulatory expectations for prudent financial management and policyholder protection. Question 14. Quality control measures reveal a recurring pattern of minor discrepancies in premium calculations within the policy administration system, leading to slight overcharges for a segment of policyholders. The system's current design allows for manual overrides of premium calculations, which appears to be the source of the inconsistencies. What is the most appropriate course of action for the underwriting department to ensure regulatory compliance and fair treatment of policyholders? Option A. Temporarily suspend all manual overrides of premium calculations until a full system upgrade can be implemented, accepting that this may slow down policy issuance. Option B. Focus on correcting the specific policyholder records identified with discrepancies and document the manual corrections made, assuming the issue is isolated to a few instances. Option C. Issue a directive to all underwriting staff to exercise greater diligence when manually overriding premium calculations, emphasizing the importance of accurate data entry. Option D. Implement a mandatory system-wide audit of all policyholder premium calculations, followed by a review and update of the system's data validation rules to prevent manual overrides from creating discrepancies, and establish a process for proactive refunding of overcharged premiums. The correct answer is D. Implement a mandatory system-wide audit of all policyholder premium calculations, followed by a review and update of the system's data validation rules to prevent manual overrides from creating discrepancies, and establish a process for proactive refunding of overcharged premiums. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the immediate need for efficient policy administration with the overarching regulatory obligation to maintain accurate and up-to-date policyholder records. The challenge lies in identifying and rectifying systemic issues within the policy administration system that could lead to mispriced premiums, incorrect benefit payouts, or breaches of regulatory reporting requirements. Careful judgment is required to ensure that any proposed solution not only addresses the immediate data integrity issue, but also prevents recurrence, thereby safeguarding both the insurer's financial stability and the policyholder's trust, all within the strict confines of the Advanced Underwriting Exam (CII) jurisdiction's regulatory framework. The correct approach involves a comprehensive review of the policy administration system's data input and processing protocols, followed by the implementation of robust data validation rules and automated reconciliation processes. This approach is correct because it directly addresses the root cause of the data discrepancies. Regulatory frameworks, such as those governing insurance in the UK, which is the implied jurisdiction for CII exams, mandate that insurers maintain accurate and complete records. The Financial Conduct Authority, FCA handbook, for instance, emphasizes the importance of treating customers fairly, which includes ensuring that policy terms and conditions are correctly applied and that policyholders are charged appropriate premiums. Implementing enhanced data validation and reconciliation aligns with these principles by ensuring data integrity, which underpins fair treatment and accurate policy administration. An incorrect approach would be to simply correct the identified policyholder data manually without investigating the systemic cause. This is professionally unacceptable because it fails to address the underlying flaw in the policy administration system. Such an approach risks the same errors recurring, potentially leading to ongoing miscalculations and a failure to meet regulatory obligations for accurate record keeping. It also demonstrates a lack of proactive risk management, which is a key expectation under regulatory oversight. Another incorrect approach would be to prioritize the speed of policy issuance over data accuracy, assuming that minor discrepancies can be rectified later. This is ethically and regulatorily unsound. The FCA's principles, particularly Principle 6 customers, information and knowledge, and Principle 7 customers, communication, require firms to provide clear and accurate information and to act in the best interests of their customers. Deliberately overlooking data accuracy, even temporarily, can lead to incorrect policy terms being communicated, premiums being miscalculated, and ultimately, a failure to treat customers fairly. This approach prioritizes operational efficiency at the expense of regulatory compliance and customer welfare. A third incorrect approach would be to blame individual data entry staff without examining the system's design and user interface. This fails to acknowledge that system design flaws or inadequate training can contribute significantly to data errors. Regulatory expectations often extend to ensuring that systems are fit for purpose and that staff are adequately trained to use them. Focusing solely on individual blame without a systemic review is a superficial fix that does not address the potential for future errors stemming from the system itself. The professional decision-making process for similar situations should involve a structured approach. First, identify the nature and extent of the data discrepancy. Second, investigate the root cause, considering both system design and human factors. Third, evaluate the potential impact of the discrepancy on policyholders and the insurer, including regulatory implications. Fourth, develop and implement a solution that addresses the root cause, incorporates preventative measures, and ensures compliance with all relevant regulations. Finally, establish ongoing monitoring to confirm the effectiveness of the implemented solution. Question 15. Operational review demonstrates that a firm's underwriting processes have several identified deficiencies, including outdated risk assessment models, inadequate documentation of underwriting decisions, and a lack of consistent application of underwriting guidelines across different teams. The firm is facing pressure to address these issues promptly to avoid potential regulatory sanctions. Which of the following approaches best aligns with the regulatory framework and professional best practice for remediating these deficiencies? Option A. Focus on implementing the cheapest and quickest solution to address the identified deficiencies, even if they do not fully resolve the underlying issues. Option B. Address only the deficiencies that are most visible to external stakeholders or that can be rectified with minimal disruption to current business operations. Option C. Implement a phased remediation plan that prioritizes deficiencies based on their potential impact on regulatory compliance and consumer outcomes, involving root cause analysis, targeted corrective actions, and ongoing monitoring. Option D. Defer significant remediation efforts until a formal regulatory investigation is initiated, at which point a comprehensive response can be prepared. The correct answer is C. Implement a phased remediation plan that prioritizes deficiencies based on their potential impact on regulatory compliance and consumer outcomes, involving root cause analysis, targeted corrective actions, and ongoing monitoring. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the immediate need to address identified deficiencies with the potential impact on business operations and client relationships. The underwriter must exercise sound judgment to ensure compliance with regulatory requirements while maintaining business continuity and upholding ethical standards. The correct approach involves a structured, risk-based remediation plan that prioritizes the most critical deficiencies. This approach is right because it directly addresses the regulatory imperative to rectify issues promptly and effectively. The Financial Conduct Authority (FCA) Handbook, specifically in areas related to firm conduct and supervision, e.g., CISC systems and controls, mandates that firms have adequate systems and controls in place to manage risks and comply with regulatory obligations. A systematic remediation plan demonstrates a commitment to these principles by identifying root causes, developing targeted solutions, and establishing clear timelines and accountability for implementation. This proactive stance minimizes the risk of further regulatory breaches and protects consumers. An incorrect approach that focuses solely on addressing the most visible or easily rectifiable deficiencies without a thorough root cause analysis fails to meet regulatory expectations. This could lead to superficial fixes that do not address the underlying systemic issues, leaving the firm vulnerable to repeat problems and further regulatory scrutiny. Such an approach neglects the FCA's emphasis on robust internal controls and a culture of compliance. Another incorrect approach that involves delaying remediation until a formal regulatory investigation is initiated is also professionally unacceptable. This reactive stance indicates a lack of proactive risk management and a disregard for the firm's ongoing duty to comply with regulations. The FCA expects firms to identify and address issues independently and promptly, rather than waiting for external pressure. This approach risks significant reputational damage and potential enforcement action. Finally, an approach that prioritizes cost-saving measures over the thoroughness of remediation, potentially by implementing less effective solutions or cutting corners on necessary resources, is ethically and regulatorily unsound. This demonstrates a failure to act with integrity and due skill, care, and diligence, which are core principles of conduct expected by the FCA. It also undermines the firm's ability to protect consumers and maintain market integrity. The professional decision-making process for similar situations should involve 1. Understanding the full scope and impact of the identified deficiencies. 2. Conducting a thorough root cause analysis for each deficiency. 3. Prioritizing remediation efforts based on regulatory risk, consumer impact, and operational significance. 4. Developing a detailed, time-bound remediation plan with clear ownership and monitoring mechanisms. 5. ensuring adequate resources are allocated for effective remediation. 6. Regularly reviewing progress and adapting the plan as necessary. 7. Communicating transparently with relevant stakeholders, including the regulator if required. Question 16. The audit findings indicate that a significant new client application was fast-tracked for underwriting approval, with several mandatory compliance checks, including Know Your Customer (KIC) verification and anti-money laundering (AML) screening, being marked as pending at the time of decision. The underwriter responsible for this case is now facing pressure to justify the decision to proceed without full confirmation of these checks, citing the potential loss of substantial business. What is the most appropriate course of action for the underwriter in this situation, adhering strictly to the regulatory framework and guidelines applicable to the Advanced Underwriting Exam (CII)? Option A. Delegate the responsibility for ensuring the completion of the pending compliance checks to the sales team, trusting their assurance that these will be addressed promptly. Option B. Prove the underwriting decision based on the potential value of the business, with the understanding that the compliance checks will be completed at a later stage, assuming the client is accepted. Option C. Immediately halt the onboarding process for the new client and insist on the completion and satisfactory review of all pending compliance checks before any underwriting decision is finalized or communicated. Option D. Proceed with the underwriting decision, but make a note in the file that the compliance checks are pending and will be completed retrospectively within a short time frame. Correct answer is C. Immediately halt the onboarding process for the new client and insist on the completion and satisfactory review of all pending compliance checks before any underwriting decision is finalized or communicated. Explanation. This scenario presents a professional challenge due to the conflict between the immediate need to secure a significant new piece of business and the imperative to adhere to stringent compliance procedures. The underwriter faces pressure to expedite the process, potentially leading to shortcuts that could compromise the integrity of the underwriting decision and expose the firm to regulatory sanctions and reputational damage. Careful judgment is required to balance commercial objectives with regulatory obligations. The correct approach involves a thorough and documented review of all compliance checks, even if it delays the onboarding of the new client. This upholds the principle of treating customers fairly by ensuring that all clients are assessed against the same robust standards, regardless of their potential business value. Specifically, it aligns with the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 3, Customers' Interests, and Principle 6, Communicating with Clients, which necessitate acting with integrity and ensuring that clients are treated fairly. The FCA's Conduct of Business Sourcebook (COBS) also mandates appropriate due diligence and risk assessment. By insisting on complete compliance checks, the underwriter demonstrates a commitment to regulatory adherence and risk management, which is paramount in advanced underwriting. An incorrect approach would be to bypass or expedite compliance checks based on the perceived value of the client. This failure to conduct adequate due diligence is a direct contravention of regulatory requirements. It could lead to the onboarding of clients who pose a significant risk, such as those involved in financial crime or who do not meet the firm's risk appetite. Such an action would violate FCA principles, particularly Principle 1, Integrity, and Principle 3, Customers' Interests, as it prioritizes profit over responsible business conduct. Furthermore, it could expose the firm to significant fines and reputational damage if discovered during a regulatory inspection or through internal audit. Another incorrect approach would be to delegate the responsibility for ensuring compliance checks are completed to the sales team without adequate oversight or verification. While collaboration is important, the ultimate responsibility for ensuring compliance rests with the underwriting function. This abdication of responsibility undermines the control framework and increases the risk of non-compliance. It fails to demonstrate the necessary due diligence and oversight expected of an advanced underwriter and could lead to breaches of regulatory obligations related to risk management and internal controls. A further incorrect approach would be to proceed with the underwriting decision based on an assumption that the client will eventually meet all compliance requirements. This reliance on future compliance is speculative and does not satisfy the immediate regulatory need for verified information. It introduces an unacceptable level of risk and demonstrates a lack of diligence in the underwriting process, potentially leading to breaches of regulatory rules concerning risk assessment and client acceptance. A professional decision-making process for similar situations should involve a clear understanding of the firm's compliance policies and procedures, as well as the relevant regulatory framework. When faced with pressure to expedite, the underwriter must first identify the specific compliance checks that are outstanding and assess the associated risks. They should then communicate clearly with all relevant parties, including the sales team and management, about the necessity of completing these checks and the potential consequences of not doing so. If commercial pressures are significant, the underwriter should escalate the matter to senior management, providing a clear risk assessment and seeking guidance on how to proceed in a compliant manner, rather than making unilateral decisions that compromise regulatory standards. Question 17. Consider a scenario where an underwriter is reviewing the capital adequacy of an insurance undertaking operating within the UK, which is subject to the Solvency II regulatory framework. The firm has a significant portfolio of life insurance business and a growing volume of non-life insurance products. The underwriter is tasked with assessing whether the current capital held is sufficient to meet regulatory expectations. Which of the following approaches best reflects the regulatory capital requirements under Solvency II for this scenario? Option A. Applying a fixed percentage of gross written premiums across all business lines to determine the capital allocation, assuming this provides a consistent buffer. Option B. Focusing primarily on meeting the minimum capital requirement, MCR, as it represents the absolute minimum capital the firm must hold at all times. Option C. Relying on historical capital adequacy ratios from previous years, assuming that past performance is indicative of future capital needs. Option D. Ensuring the firm holds capital that comfortably exceeds the solvency capital requirement, SCR, and is adequately diversified across its business lines based on their respective risk profiles. Correct answer is D. Ensuring the firm holds capital that comfortably exceeds the solvency capital requirement, SCR, and is adequately diversified across its business lines based on their respective risk profiles. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for robust regulatory capital with the practicalities of business operations and market competitiveness. Misinterpreting or misapplying regulatory capital requirements can lead to significant financial penalties, reputational damage, and even the inability to trade. The underwriter must demonstrate a deep understanding of the underlying principles of regulatory capital, not just the mechanics of calculation, to ensure the firm's solvency and compliance. The correct approach involves accurately assessing the firm's risk profile and applying the relevant Solvency II, as per CII Advanced Underwriting Exam Jurisdiction, capital requirements. This means understanding the different components of the solvency capital requirement, SCR, and the minimum capital requirement, MCR, and how they relate to the firm's specific business activities, asset holdings, and liabilities. The regulatory justification lies in the core purpose of Solvency II, which is to ensure that insurance and reinsurance undertakings hold sufficient capital to cover their risks and protect policyholders. This approach directly aligns with the prudential framework designed to maintain the stability of the insurance sector. An incorrect approach would be to focus solely on the minimum capital requirement, MCR, without adequately considering the solvency capital requirement, SCR. This is a regulatory failure because the MCR is a floor, and the SCR represents the true capital needed to absorb unexpected losses. Relying only on the MCR could leave the firm undercapitalized for significant adverse events, violating the spirit and letter of Solvency II. Another incorrect approach would be to adopt a one-size-fits-all capital allocation strategy across different business lines without a proper risk-based assessment. This fails to acknowledge that different insurance products and operations carry varying levels of risk. Solvency II mandates a risk-sensitive approach, and failing to differentiate capital allocation based on risk would be a significant regulatory and ethical lapse, potentially leading to mispricing of risk and inadequate capitalization in high-risk areas. A further incorrect approach would be to assume that historical capital levels are automatically sufficient for current and future risk exposures. Regulatory capital requirements are dynamic and should reflect the current risk environment and the firm's evolving business model. Sticking to outdated capital adequacy assessments ignores the forward-looking nature of prudential regulation and could lead to a capital shortfall. The professional decision-making process for similar situations should involve a thorough understanding of the firm's business model, its risk appetite, and the specific requirements of the relevant regulatory framework, Solvency Roman II in this context. This includes regular review and stress testing of capital adequacy, seeking expert advice when necessary, and maintaining clear documentation of the rationale behind capital decisions. The ultimate goal is to ensure both regulatory compliance and the long-term financial health of the undertaking. Question 18. Strategic planning requires actuaries to provide robust estimates for future liabilities. When faced with pressure from the board of directors to present a more favorable solvency position, which approach best upholds the actuary's professional and regulatory responsibilities under the UK framework? Option A. Employ simplified reserving techniques that historically have resulted in lower reserve figures, assuming these will be sufficient to meet future claims without detailed analysis of current trends. Option B. Adjust actuarial assumptions to align with the board's desired solvency ratio, prioritizing short-term financial reporting over a strictly objective assessment of liabilities. Option C. Present a single, optimistic reserve figure without disclosing the range of potential outcomes or the sensitivity of the estimate to key assumptions, to avoid causing undue concern to the board. Option D. Select actuarial methods and assumptions that prudently reflect the best estimate of future liabilities, even if this results in higher reserve requirements, and clearly communicate the rationale and any inherent uncertainties to the board. The correct answer is D. Select actuarial methods and assumptions that prudently reflect the best estimate of future liabilities, even if this results in higher reserve requirements, and clearly communicate the rationale and any inherent uncertainties to the board. Explanation. This scenario presents a professional challenge because actuaries are tasked with estimating future liabilities, which inherently involves uncertainty. The pressure to present a favorable financial picture can conflict with the actuarial duty to provide an objective and prudent estimate of reserves. The stakeholder perspective, particularly from the board of directors, adds a layer of complexity as their focus may be on short-term profitability and solvency ratios, potentially influencing their perception of appropriate reserving levels. The correct approach involves the actuary exercising professional judgment to select appropriate actuarial methods and assumptions that are consistent with the long-term financial health of the company and regulatory requirements. This includes using a range of techniques and considering various scenarios to arrive at a prudent estimate of reserves. The regulatory framework for actuaries in the UK, as governed by the Financial Reporting Council (FRC) and the Institute and Faculty of Actuaries (IFOA), mandates that actuaries act with integrity, objectivity, and due professional care. Specifically, the Technical Actuarial Standards (TAS) and the actuarial profession's ethical standards and guidance require actuaries to ensure their valuations are based on sound actuarial principles and that they consider the implications of their assumptions on the financial statements and the company's solvency. The actuary must be able to justify their chosen methods and assumptions, even if they lead to higher reserve levels than management might prefer. An incorrect approach would be to adjust actuarial assumptions solely to meet a predetermined profit target or to align reserves with management's desired financial outcomes without robust actuarial justification. This would violate the principle of objectivity and integrity, as it prioritizes external pressures over sound actuarial practice. Such an action could lead to understating liabilities, potentially misrepresenting the company's financial position to regulators, shareholders, and policyholders, and could have serious solvency implications. It would also breach the FRC's ethical standard for actuaries, which requires actuaries to maintain objectivity and avoid conflicts of interest. Another incorrect approach would be to adopt overly simplistic or outdated reserving methodologies that do not adequately capture the complexity of the risks being underwritten, even if they result in lower reserve requirements. While this might appear to satisfy a desire for lower reserves, it fails to meet the duty of due professional care and the requirement to use appropriate actuarial techniques. This could lead to inadequate provisioning for future claims, jeopardizing the company's long-term solvency and its ability to meet its obligations to policyholders. This would also be a failure to comply with the spirit and letter of the TAS, which emphasize the need for appropriate and robust methodologies. A third incorrect approach would be to present a single, highly optimistic reserve figure without disclosing the inherent uncertainties or the range of possible outcomes. This lacks transparency and fails to provide stakeholders with a complete picture of the potential liabilities. Actuaries have a professional responsibility to communicate the limitations of their estimates and the sensitivity of their results to changes in assumption. Failing to do so undermines trust and can lead to poor strategic decisions based on incomplete information. This would be a breach of the ethical duty to communicate effectively and transparently. The professional decision-making process for actuaries in such situations should involve a clear understanding of their professional obligations and ethical duties. They should first identify the potential conflict between stakeholder expectations and actuarial best practice. The actuary must then rely on their professional judgment, supported by robust data and appropriate actuarial techniques, to determine the most prudent estimate of reserves. If there is disagreement with management or the board, the actuary should clearly articulate the actuarial rationale for their position, referencing relevant standards and ethical guidance. They should be prepared to explain the implications of different reserving approaches on the company's financial position and solvency. If the disagreement persists and the actuary believes that the company's financial reporting or solvency is being compromised, they have a professional and ethical obligation to escalate the matter appropriately, which may include reporting to the regulator. Question 19. The audit findings indicate that the current underwriting guidelines for a specific life insurance product may be inadvertently leading to disparate outcomes for certain demographic groups, raising concerns about potential unfair discrimination. As an underwriter, what is the most appropriate course of action to address these findings? Option A. Immediately cease using all historical data in the underwriting process for this product to avoid any potential for bias, and rely solely on prospective applicant information. Option B. Continue to apply the existing underwriting guidelines as they are based on established actuarial principles and historical data, assuming that any observed disparities are purely coincidental. Option C. Update the underwriting documentation to include a disclaimer acknowledging the possibility of disparate outcomes without altering the underlying assessment methodology. Option D. Conduct a comprehensive review of the underwriting guidelines and the data sources used, identifying any criteria that may be contributing to biased outcomes, and subsequently revise the guidelines and data usage to ensure objective and equitable risk assessment. Correct answer is D. Conduct a comprehensive review of the underwriting guidelines and the data sources used, identifying any criteria that may be contributing to biased outcomes, and subsequently revise the guidelines and data usage to ensure objective and equitable risk assessment. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for accurate risk assessment with the potential for bias, which can lead to unfair discrimination. The audit findings highlight a systemic issue that could compromise the integrity of underwriting decisions. Careful judgment is required to ensure that risk assessment is based on objective, relevant factors, and not on assumptions or stereotypes. The correct approach involves a thorough review of the underwriting guidelines and the specific data used in the assessment to identify any potential biases. This includes examining the sources of data, the criteria used for risk classification, and the statistical models employed. The underwriter must then implement corrective actions to mitigate any identified biases, ensuring that all applicants are treated fairly and equitably, in line with the principles of good underwriting practice and regulatory expectations for fairness and non-discrimination. This aligns with the overarching regulatory duty to conduct business with integrity and to avoid unfair discrimination, which is a fundamental principle in insurance regulation. An approach that relies solely on historical data without critically examining its potential for bias is professionally unacceptable. Historical data can reflect past societal biases, and using it uncritically can perpetuate discrimination. This fails to meet the regulatory expectation of actively identifying and mitigating bias in underwriting processes. Another incorrect approach is to dismiss the audit findings without a detailed investigation. This demonstrates a lack of due diligence and a failure to address potential systemic issues that could lead to regulatory breaches and reputational damage. It neglects the professional responsibility to ensure that underwriting practices are sound and compliant. Furthermore, an approach that focuses only on superficial changes to documentation without addressing the underlying assessment methodology is also flawed. True risk assessment requires a deep understanding and application of objective criteria, and any corrective actions must address the core of the problem, not just its outward appearance. This approach fails to uphold the principle of robust and evidence-based underwriting. The professional decision-making process for similar situations should involve a systematic review of audit findings, a critical evaluation of current practices against regulatory requirements and ethical principles, and the implementation of targeted, evidence-based corrective actions. This process should be iterative, with ongoing monitoring to ensure the effectiveness of the implemented changes. Question 20. Market research demonstrates that insurers are increasingly exploring the integration of artificial intelligence, AI, into their underwriting processes. Considering the regulatory landscape and ethical considerations within the UK financial services sector, which of the following approaches best reflects a responsible and compliant implementation of AI in underwriting? Option A. Implementing AI-driven underwriting tools after conducting thorough due diligence on the AI vendor, validating the AI models for bias and accuracy against regulatory requirements, and establishing clear internal governance for their ongoing monitoring and review. Option B. Relying solely on the AI vendor's proprietary algorithms and data sources, assuming their internal testing is sufficient to meet all UK regulatory obligations. Option C. Utilizing AI to automate underwriting decisions without establishing mechanisms for human oversight or the ability to explain the rationale behind AI-generated outcomes to customers or regulators. Option D. Adopting AI-powered underwriting platforms immediately based on vendor claims of compliance and efficiency, with minimal internal review to gain a competitive advantage. The correct answer is A. Implementing AI-driven underwriting tools after conducting thorough due diligence on the AI vendor, validating the AI models for bias and accuracy against regulatory requirements, and establishing clear internal governance for their ongoing monitoring and review. Explanation. This scenario is professionally challenging because it requires underwriters to balance the potential benefits of AI in enhancing efficiency and accuracy with the imperative to maintain regulatory compliance, ethical standards, and fairness in underwriting decisions. The rapid evolution of AI technology means that established underwriting principles must be re-evaluated in light of new capabilities, creating a dynamic and complex environment. Careful judgment is required to ensure that AI is implemented in a way that upholds the integrity of the underwriting process and protects consumers. The correct approach involves a comprehensive review and validation of AI models to ensure they are free from bias and comply with all relevant regulations, such as those pertaining to data privacy and non-discrimination. This includes understanding the data sources used by the AI, the algorithms employed, and the outputs generated. Justification for this approach lies in the regulatory framework that mandates fair and equitable treatment of all applicants. For instance, under the Financial Services and Markets Act 2000, FSMA, and associated FCA principles for businesses, firms have a responsibility to treat customers fairly and to ensure that their systems and controls are robust. The use of AI must not lead to discriminatory outcomes, even if unintentional. Furthermore, the Insurance Conduct of Business Sourcebook, ICOBS, requires firms to act honestly, fairly, and professionally in accordance with the best interests of their customers. Validating AI models against these principles is paramount. An incorrect approach would be to blindly adopt AI-driven underwriting without adequate oversight, assuming that the technology inherently produces fair outcomes. This fails to acknowledge the potential for algorithmic bias, which can arise from biased training data or flawed model design. Such an approach would likely violate the FCA's principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, if it leads to unfair pricing or denial of cover based on protected characteristics. Another incorrect approach is to rely solely on the vendor's assurances regarding the AI's compliance and fairness. While vendor due diligence is important, the ultimate responsibility for regulatory compliance rests with the underwriting firm. Failing to conduct independent validation and testing of the AI models would be a significant regulatory failure, potentially breaching the duty to have adequate systems and controls in place, as required by SISC, Senior Management Arrangements, Systems and Controls, in the FCA Handbook. A further incorrect approach is to use AI to automate underwriting decisions without maintaining a clear audit trail or the ability to explain the rationale behind individual decisions. This lack of transparency can hinder regulatory scrutiny and make it difficult to address customer complaints or challenges to underwriting outcomes. It also undermines the principle of accountability, which is central to regulatory oversight. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the business objectives for implementing AI. Second, conduct thorough due diligence on AI vendors and technologies, focusing on their data governance, bias mitigation strategies, and compliance frameworks. Third, establish robust internal governance and oversight mechanisms for AI deployment, including clear roles and responsibilities for validation, monitoring, and ongoing review. Fourth, ensure that AI models are regularly tested and audited for fairness, accuracy, and compliance with all applicable regulations. Finally, maintain transparency and explainability in AI-driven decisions, ensuring that underwriters can understand and, if necessary, override AI recommendations, and that customers can receive clear explanations for underwriting outcomes.